How the world's biggest financial market actually works. Every single day, trillions of dollars move through the Forex market. Banks, government, corporations, hedge funds, and millions of traders around the world continuously exchange currencies. Yet, despite Forex being the largest financial market on Earth, most people still don't fully understand how it actually works. Some people see Forex as a way to build financial freedom. Others see it as one of the riskiest financial environments in the world. Social media often shows luxury lifestyles connected to Forex trading. Expensive cars, watches, private jets, fast profits. But behind the flashy lifestyle content, Forex is deeply connected to global economics, central banks, geopolitics, and financial psychology. So in this video, we'll fully break Forex down. What Forex actually is, how currencies move, how traders try to make money, why most traders fail, how the Federal Reserve influences Forex, and why this market quietly affects almost every economy on Earth. What is Forex? Forex stands for foreign exchange. It's the global marketplace where currencies are exchanged. For example, US dollars into euros, Japanese yen into British pounds, euros into Swiss francs. Every country uses its own currency. And because countries constantly trade with each other, currencies are always being exchanged. International companies need foreign currencies to operate globally. Tourists exchange money when traveling. Governments move reserves between currencies. And investors speculate on currency movements trying to profit from price changes. All of this activity creates the Forex market. Unlike stock markets, Forex is decentralized. There is no single central exchange. Instead, Forex operates through a massive network of banks, institutions, brokers, and financial systems around the world. And because global markets open in different time zones, Forex operates almost 24 hours a day. The major Forex trading sessions are London, New York, Tokyo, Sydney. As one market closes, another opens. This continuous activity makes Forex the most liquid financial market in the world. How currency pairs work. In Forex, currencies are traded in pairs. Examples include USD, USD JPY, USD CHL. The first currency is called the base currency. The second is called the quote currency. For example, in Euro USD, the euro is the base currency and the US dollar is the quote currency. If Euro USD rises, it means the euro is becoming stronger compared to the dollar. If Euro USD falls, the dollar is becoming stronger compared to the euro. Forex trading is essentially predicting which currency will strengthen or weaken relative to another. This movement happens because investors constantly react to economic growth, inflation, political stability, interest rates, market fear, and global events. Currencies represent economic confidence. What are pips and spreads? One of the first concepts beginners learn in Forex is the pip. A pip is the smallest standard price movement in most currency pairs. Forex prices move in tiny increments. For example, USD might move from 3,000 to 1,005. That small movement equals several pips. Because Forex markets are highly liquid and stable compared to crypto, traders often use leverage to amplify these small movements. Another important concept is the spread. The spread is the difference between the buy price, and the sell price. Brokers make money partly through spreads. Smaller spreads usually happen during high market liquidity. Larger spreads often appear during volatility or major news events. Understanding pips and spreads is essential because even small costs affect long-term profitability. How leverage works. Leverage is one of the biggest reasons Forex became extremely popular. Leverage allows traders to control large positions using relatively small amounts of capital. For example, with $100, a broker may allow a trader to control $1,000 or more in the market. This dramatically increases both potential profits and potential losses. Leverage creates opportunity, but it also creates danger. Small, Market movements can quickly wipe out accounts when traders use excessive leverage. Many beginners become attracted to Forex because leverage creates the illusion of fast wealth. But leverage is also one of the biggest reasons many traders fail. Professional traders often use leverage carefully and focus heavily on risk management, because surviving the market long-term matters more than chasing quick profits. Long versus short positions. Forex allows traders to profit from both rising and falling markets. If a trader believes a currency pair will rise, they take a long position. If they believe the market will fall, they take a short position. For example, if traders believe the US dollar will become stronger, they may short your USD. If they believe the euro will strengthen, they may go long EUR/USD. This flexibility makes Forex attractive because opportunities can exist in both bullish and bearish environments. But predicting market direction consistently is extremely difficult, because currencies react to complex economic forces happening globally every day. Who really moves the Forex market? Retail traders are only a tiny part of Forex. The real market movers are central banks, our investment banks, hedge funds, multinational corporations, sovereign wealth funds. These institutions move billions of dollars constantly. When a multinational corporation exchanges currencies for international business operations, massive capital flows occur. When hedge funds reposition portfolios, currencies can move rapidly. But the most powerful institutions in Forex are central banks, especially the Federal Reserve. The European Central Bank, the Bank of Japan, the Bank of England. Why interest rates matter so much? Interest rates are one of the biggest drivers of Forex markets. Why? Because higher interest rates can attract investors seeking stronger returns. For example, if the Federal Reserve raises interest rates aggressively, global investors may move money into US dollar assets. This increases demand for dollars. As demand rises, the dollar often strengthens. Currencies are deeply connected to investor confidence. Markets constantly compare which economies are stronger, which central banks are more aggressive, and where capital can earn better returns. This creates constant movement between currencies, and this is why traders watch central bank speeches obsessively. Sometimes one sentence from the Federal Reserve can move the Forex market dramatically within seconds. Economic news and volatility. Forex markets react heavily to economic data. Some of the most important reports include inflation data, unemployment numbers, GDP growth, interest rate decisions, non-farm payrolls, CPI reports. When economic numbers surprise the market, currencies can become extremely volatile. For example, if inflation suddenly rises higher than expected, investors may believe the Federal Reserve will keep rates higher longer. This could strengthen the dollar rapidly. Forex traders around the world monitor economic calendars constantly because news events can create massive price swings, and during major economic announcements, volatility can become extremely dangerous. Why the US dollar dominates Forex? The US dollar is the world's reserve currency. Most international trade still happens using dollars. Oil markets, global banking systems, and international finance all heavily depend on the dollar. Because of this, the dollar appears in most major Forex pairs. Examples: USD, USD JPY, USD CAD. The strength of the dollar affects the entire global economy. When the dollar becomes stronger, emerging markets often struggle. Debt becomes more expensive globally. And commodities can weaken. This gives the Federal Reserve enormous global influence. Many Forex traders focus almost entirely on US economic data because the dollar drives so much of the market. Forex is much more than just charts and trading screens. It's a reflection of global economics, monetary policy, political stability, inflation, and investor confidence. Currencies represent the strength and perception of entire nations, and every movement inside the Forex market tells a story about what investors believe may happen next. Some people enter Forex hoping for fast wealth, but long-term survival in the market usually depends on discipline more than excitement. Because in the world's biggest financial market, understanding how money moves may be just as important as making money itself.